To make a move like that, you have to have kahunas and conviction.
Long term, I'm bullish. We could see about a 20% correction next year.
This is Josh Jalinski, the financial quarterback. Don't touch that dial. Hi, everybody. This is Josh Jalinski, the financial quarterback. And we have economic legend and friend of the broadcast, David Ranson, who I'm going to make up shirts that say David Ranson was right and everybody else was wrong, because you were one of the few people. There were a couple people, but not many. Many had said we would go into a deflationary spiral or a disinflationary spiral. And you had predicted correctly, 2 years ago, when people thought we would be in a deflationary morass. So before we get to your Ranson was right hypothesis, let's talk about your background. So describe your background for those who are not familiar with your work.
Well, okay. I'm English, but I went to the University of Chicago for graduate school and got my economic and finance training there. And I've been working in the same field ever since. I worked for a while at Boston Consulting Group, and for another while, I was in the federal government working for George Shultz, who at that time was director of the Office of Management and Budget. He subsequently became Treasury Secretary, and I went along to the Treasury to serve as a special assistant there too for a few more years, and worked for Bill Simon, who succeeded Shultz. Since then, I've been involved in HC Wainwright and Co economics, which we've now renamed HCWE. All this time, I've been working on writing research papers on the capital markets.
Wonderful. And we'll talk about many of those, your thoughts on gold, inflation. So what was it like growing up, being taught by the likes of Milton Friedman and others?
Oh, it was pretty harsh, actually. Friedman was a harsh master, and it was difficult to get a decent grade in his course. His reading list, I think it must have been 12 pages long. I could possibly have gotten through it, but I made it through the course. I didn't fail, at least. And then he gave another course on national income and employment, and I did much better. I started to get the hang of it.
Wonderful. So let's talk about what prompted you to get this inflation call right, where others who we respect got it wrong.
It's a matter of where you think inflation comes from. The majority opinion talk as if it's an imbalance between supply and demand. That's not right. You can have an imbalance between supply and demand in any industry, any time, but unless you have money circulating, there is no way to measure inflation at all. So in order to have inflation, you have to have a money system. Inflation has got to be a property of the money system. And of course, a high inflation rate is a sign of disease and something being wrong.
So something is wrong now. What is your prescription? I mean, how would you characterize where we are today? You came on, said inflation would be persistent. When other people said CPI would go lower, you said it would stay high and persistent. I do want to get your thoughts on where you think it's headed in the future. But why did you get it so right? Why did others get it so wrong? I mean, good people.
Well, you have to have the right indicator. There aren't very many inflation indicators that have consistently been right over the years and over the decades. And one of them, that has been pretty good, but not perfect by a long shot, is the price of gold. Price of gold tells you what the value of the dollar is. And if the dollar declines relative to gold, it's going to decline relative to everything else in the economic system sooner or later. In the most recent period, I did some research that suggested you can't use the price of spot gold because it's a safe haven investment. And safe haven investments have prices which are distorted when you have a very high level of anxiety of the kind that we had when the pandemic came along. But if you use the distant forward price of gold, you can get rid of that dependence on current events. And that indicator has worked very well for the last 3 years. It's hardly missed a beat.
So yeah, this indicator, describe what we would call this. Is this the Ranson indicator? It's always confusing to me because you take the forward, let me see if I get this right. I've had you on so many times. You take the forward spot price of gold as indicated by the gold futures market, and there's a ratio relative to the strips, but like the 30-year Treasury strips, something like that?
Well, that's two different ways of doing it. The easiest way to do it is to use Treasury strips, or zeros as they're called, to estimate what the price of gold in a market 30 years out would be if we were trading gold that way. Not very many people do trade that way, but we certainly do trade an awful lot of Treasury bonds 30 years out. So the price is pretty reliable. It's the market indication of what the price of gold is most likely to be 30 years from now.
And what is that? No, but what I'm saying is, where do we get this? I mean, Yahoo Finance doesn't have a Ranson indicator button yet, like the McClellan oscillator, things like that. How do you come up with it? You take the forward price of gold, and the only reason I'm getting this is you've gotten this right where so many other people got it wrong. So I want to be able to like look it up.
Yeah, economists don't really study the gold futures market very much, but those who are in the gold futures market know very well that the price, say 1 year futures, relative to the current price, the spot price, is equal to the interest rate. It's just the spot price grossed up by the interest rate. And if you want the 5-year futures price for gold, it's the spot price grossed up for 5 years of interest.
Which one do you look at? The 5-year, the 30, all of them?
I look at the 30. I want to get as far away from current conditions as possible because there's a lot of things that are very abnormal about the world today. The Ukraine war, the pandemic is not over completely. All sorts of other scares, anxieties are troubling markets, and they obscure what we need to know, which is the inflation signal.
So what's a 30-year
So I go out as far
gold?
as I possibly can, and the yield curve allows me to go out to 30 years using treasuries.
Okay. So how do I do that? So what does that tell you now? What does it tell us now?
It tells us that the price of, I call it the forward price of gold, that's 30 years out, has risen more than 50% since the beginning of this year. Wow. It's an extraordinary rise following a rise last year, which was only, I think, about 20% and stabilized. But this year has been much worse than last year.
And what does it suggest for the future, since you were right on this inflation call?
Well, again, if the dollar loses its value relative to something which is very, very stable over long, long periods of time, hundreds or thousands of years, the price of gold has been a stable asset. If the dollar loses that much against gold, and it's in the forward market, so it's not distorted by current events, then it's a sign that the dollar has lost value against everything, and the purchasing power of the dollar is bound to fall, and it has.
So the gold, so are you looking at gold, for example, gold December 23 is like 1734? So do you take
that's the spot price? Yes, that's the spot price is the one that everybody sees and gets reported in the newspapers. You have to be a little bit more specialized to go into the futures market, and you won't be able to go into the futures market beyond about 5 or 6 years. Okay. You have to bring in the Treasury yield curve to estimate what futures prices would be further out.
So I really want you to break down, because we know this indicator was so good. So how do I calculate it today for the future? Like, where do I go? What website? I know I got to dig, But I'm on. Do I go to? I feel like you told me this once. It was like Bank of America, the ICE index or something.
Well, the price that we have to look up is the price of a zero coupon bond.
Okay.
And as I say, I prefer the 30-year price. That's the furthest out you can go. So that's the furthest away from distortion.
Okay. So what's the price of a 30-year now today? Do we know or about?
I'd have to look that up. I don't carry it in my head.
Is that something called the S&P U.S. Treasury Principal Strips 20 to 30-year bond index? That one or no? It's different.
It's similar to that, but it's a 30-year, and the source is something called Intercontinental Exchange.
Okay.
The database originally came from Merrill Lynch, and Merrill Lynch's database was bought up by Bank of America, and Bank of America, I believe, sold it. I don't know the details, but I think Intercontinental Exchange is the website you need to go to, and you'll get a very large number of different indexes of different things. But the index that I use is the 30-year Treasury strip or principal strip or zero.
So that lost a lot this year. What does it portend to CPI a year out from now? Like what does your research suggest?
It suggests a very high rate of CPI inflation for years to come.
So how do we recover from that? I mean, that's so you're still holding we're going to have persistent inflation for a while.
Yes, it's not quite as bad as it sounds. The CPI is announcing price changes very, very late. It's the way the index is constructed. There are lags involved. And that's why it takes so long for the CPI to come back to any kind of equilibrium. But the real action is at the front end. The CPI doesn't respond that much at the front end. It carries on responding for months and years to come. But the real action, the real damage being done to the economy is happening right there in the immediate, much more immediate future. And it's better to use a different kind of price index to capture that action. I use the PPI or something close to it. I use what's called the Producer Goods Index, which is very similar to the PPI. And it responds much more quickly. Even that, it takes years before it fully reflects the change in the inflation situation that is already begun.
So when do things start to cool?
When the dollar stops falling relative to the long-term stable value of gold. And you ask, when would that be? And there's no answer to that question. It all depends on how the government manages the monetary system. If everybody has full confidence that the system is being managed sensibly and not recklessly, then the dollar should stabilize. But we have here a recent history of spending trillions of dollars, both fiscal and monetary policy, which is extremely reckless. And in fact, there's very little evidence that it's got us out of the pandemic recession any quicker than we would have anyway. So it's a reckless management of the monetary system, which is being objected to by the general public and especially the financial markets. And the dollar just keeps on declining as it would in any other country.
So I remember I was asking, so if you were to make a prediction, November CPI, I mean, October CPI was released, surprised people a little bit to the upside. People were predicting 8.1, 6-7%. It came in at 8.3. If you were to put a prediction in November, what would you say?
I think it'll accelerate some more. You can't be terrifically precise about this. The linkage is not perfect, but I would expect, because we've had a rise in the forward price of gold in the last couple of months, that I'm going to look at the data for closing last night to add another data point to my graphs, and that'll modify my view. But the forward price of gold is on the rise for the third time in this 2-year period.
And yeah, I'm still lost on the formula though. So you divide it in. But how do you get?
You can do. Well, there's two different ways you can do it. You get to the same answer. The simple way I do it is that I get an index. There's an index of the price of Treasury principal strips, which are the zero coupon bonds, 30-year maturity or 30-year duration. So that price is about 105, what I'm looking at, but I don't think I'm looking at the exact right index. Yeah, the indexes can be all over the place depending upon what the base is.
I'm looking at the S&P Treasury principal strips 20 to 30 year. But I know what you mean.
Yeah.
There's the ICE one.
Yeah, that's a different source. If you're using an index, you can't tell that the indexes are not on the same basis.
Okay. So what do you divide into? The price of gold divided by the 30-year ICE index?
Yes, you take the spot price of gold. I think you mentioned what it was. I don't follow it on a day-to-day basis. And you divide by this price index for 30-year Treasury strips. And you get an index as a result. And that index changes from month to month, or it changes every day, in fact. I watch it every month. And the percentage change in any given month tells you
whether inflation's going up or down, basically.
Yes.
So it's really a month-to-month indicator. You need to publicize this. We need to make this famous. I love this. Where people would have the Ranson indicator.
Well, things can get famous by being promoted, but people are skeptical about promotions. I think things that are really genuine will get famous whether or not people promote them. But it may take a long time, unfortunately. And the problem is it's very painful to wait until that happens.
Oh, fantastic. So this is interesting. So you think inflation will be persistent, because we have another analyst who's been on the show. He's been one of the only other guys who's been predicting like sort of very high interest rates for a long time. Stan Harley says, we should have 8-9% interest rates pretty soon to buy a 30-year house. Would you agree with that?
I think it's quite possible. We're talking very big numbers. I mentioned the forward price of gold is up by more than 50% since last November. And that means the value of the dollar is down. Turn it upside down, it's something like down 30 or 1/3 in that time frame. The value of the dollar has diminished by 1/3 in that time frame. These are very big numbers. And even if you spread them out over the next few years, because it'll take that long for them to fully be reported, those are very high rates of inflation. I wouldn't rule out what you said.
So common sense was common. If you inject all this money with COVID stimulus, you pump. What's interesting is there was so much talk about like a new normal by the Fed, a soft landing. But common sense would have told you that with all of the government spending, Trump, then Biden, all of these rounds of QE, weird stimulus, that kind of the dollar would become worth less over time. And it's happened. So, but it's interesting to note that isn't popular anymore, that way of thinking. But it makes common sense. Totally. So, what else? So you believe inflation will be persistent, interest rates will be persistent. You're not that bearish on a recession. I want to get your thoughts on recession, because I would lend this like, if we're going to have persistent inflation, but I think what you're getting at is it's almost like that wealth effect. Because people's houses went up 50% or 100%, they feel wealthier. They got money for sitting at home. They got PPP. They got stimulus. Money's floating around. They're buying $80,000 cars, which were $40,000 cars. But the economy necessarily, the stock market's tanking. What do you think about recession?
I think that recessions, the kind of recession you're talking about, is a serious decline in the economy over a period of, say, 6 to 12 months. Not just a tiny smidgen of negative growth in a couple of quarters, which we actually have already had. A recession takes shock to take place, I believe. Fundamentally, the view I'm taking here is really an optimistic view. It's a view that the economy handles itself very well. It doesn't need the government to push it around and put it where it needs to be. It's not a dog being walked by its owner. It is the owner. And the economy finds its own equilibrium all the time. And if it sees a threat, then it starts taking evasive action, or it adapts to the threat. So any foreseeable threat will cause the economy perhaps to weaken a bit, but only a bit, and it'll go on, it'll stay in equilibrium. If a threat appears out of the blue, completely unknown and unanticipated by anyone, and if it's serious enough, it can cause shock. And the shock is really just a surge in anxiety. And this anxiety causes people and businesses, financial markets, to freeze. And when they freeze, you have less economic activity, the economy can plunge. It doesn't necessarily last very long. Even the pandemic plunge didn't last very long, but that's what I call a recession.
So you don't really believe that high interest rates, high inflation could cause a recession? You think they may be like the environment from which one brews? You know, Scott Meinert is talking about how there's cracks at the foundation, and that before the end of the year, something big will kind of, you know, maybe we'll reach a heightened state of fear, or the VIX will go up. But you don't see that yet in your data.
No, that sounds like bearishness for the sake of bearishness. I don't think that there are any fundamental cracks in the system. The system is not being managed very well by Washington. Washington is acting as if it knows how to run the economy, although it doesn't. And the economy managed to shake off most of the intrusions upon it by politicians. So I think the economy is nearly always in equilibrium, and there's no reason to be pessimistic. But there are things that can cause a shock. One of them would be a big jump in interest rates that was completely unanticipated. This happened in the past. The Fed did create recessions in the past by raising interest rates dramatically and without warning. That doesn't happen today. I hope it never happens again. There is no shock value in the Fed raising rates. The Fed announces the rate increases, and we all know about it long in advance, and we have plenty of time to prepare. Financial markets take evasive action and adapt to the possibility that interest rates will be higher. And the damage done is, I think, quite small relative to what it used to be in the past when you have the shock effect.